A very warm welcome to everyone joining us today. I am your host Shweta. With me is AKC Capital founder and director Mr. Aditya K. Chopra. Welcome, Aditya.
Thank you.
As we continue this month's theme on equity markets and long-term wealth, today's topic is index fund, the simplest way to beat 87% of investors. Many people believe investing in stock market is complicated, but if there was a simple way to invest without having to pick individual stocks, that's exactly what we are discussing today. So my first question to you, Aditya, what exactly is an index fund and how is it different from regular mutual fund?
Well, an index fund typically mirrors the market index, be it the Sensex or the Nifty 50. So it has a similar composition to that of the market index in terms of the number of stocks and the weightage of each stock, which constitutes the market index. So if the market index moves up by 10 or 15%, then the corresponding index fund would mirror the similar performance and would move up by 10 and 15% proportionately. On the other hand, an actively managed mutual fund would have a stock composition which would be different from that of the market index. So this could be in terms of the kind of stocks. It could also be varying in terms of the composition of each stock, so on and so forth. The goal being to outperform the market index. So an actively managed fund would typically endeavor to generate an alpha, which is the excess returns over and above the returns generated by the market index. The third factor could also be the cost factor. Since an index fund is a passively managed fund, it mirrors the market index. So hence there is no active fund management or stock selection involved. Hence it has significantly lower costs. On the other hand, an actively managed mutual fund would have higher costs because of fund management skills required to select stocks and actively manage the same. So these three are the key points of difference between these categories.
So I want to ask you, how do you compare the performance of index fund vis-a-vis actively managed funds?
Well, I think this is a very good question, and I would like to break it up into three parts. One is obviously the cost factor. So obviously, as we all know, index funds have significantly lower costs vis-a-vis actively managed funds. So over a longer period in time, this could be this could be a factor which will determine the long-term CAGR in each of these two categories. But at the same time, if an actively managed fund is really doing its work, it may outperform as well. The second thing could be the active share ratio, which is nothing but how different is the composition of the actively managed fund vis-a-vis the index, vis-a-vis the market index. So active share ratio is a very common term. Higher the active ratio, greater is the chance that an actively managed fund would outperform the market index, right? So higher the active ratio is better, and lower means lesser is the probability, because it's just copying the index to a large extent. The third is also the maturity of the markets. I think generally we see that index or passive funds are generally a developed markets phenomena. So if you see today, really in US, generally you see a higher proportion of shares of passive funds, and which is significantly growing. But the same may not be true in case of emerging markets or developing markets like India or others, because in emerging markets you find a lot more opportunities to invest, and there's a higher probability that in the long run an actively managed portfolio in an emerging market would have a higher probability to outperform the market index. So when you keep these three things in mind, you can construct an optimum portfolio. What we are trying to say is that you could have in your overall portfolio have a certain composition of index funds in your portfolio, and also have active funds in your portfolio. So a healthy mix of the two eventually will be leading to right asset allocation and better risk adjusted returns.
So now we want to understand what kind of return has the Nifty 50 delivered over the long term, and what does that tell to our investors?
Well, well, I think this is a good question. So generally, when you look at Nifty 50 or the markets, have returned around a CAGR of around 13-14% over the last 25 years. Obviously, we tell clients a more conservative estimate of 12% CAGR over a longer period of time, which is linked to your GDP growth rate outlook and long-term inflation, the nominal rate of return. So I guess when you look at two market crashes which happened in recent memory, 2008 subprime crisis when markets crashed close to 60%, and then we had the COVID, which in 2020-21, when again markets did correct by around 35%. But the point here to note, while the crash happened, the markets did recover as well. So my point is that do not panic when markets crash. In fact, and there is a bloodbath, there is a good opportunity to buy into these crashes, because you're buying at extremely low valuations, provided you have cash with you. And then it will be rewarded when the markets recover in terms of multi-bagger returns. And at the same time, when you're not selling when the market crashes, you are avoiding to book the losses or realize your losses in your portfolio. So end of the day, I think investors need to be patient and give the portfolio the time for it to grow. And at the same time, keep reviewing your portfolios and do make changes wherever interventions are required. But in general, market rewards patient investors.
So my final question for the day is, if someone wants to start investing in Nifty 50 fund today, how they can begin?
Well, I think that's a fairly simple question. So today there are a plethora of options. One can use the fintech platforms. Most commonly would be Grow, Zerodha, where one can create an account online, including the KYC process as well. So this is pretty seamless for retail investors. Second would be platforms provided by banks and NBFCs. So most of the banks today have their own investment platforms for wealth and retail clients. So these are fairly simple. In fact, this is simpler because everybody has their own bank they deal with, and they can always reach out to the bank to start activating these platforms, right? The third is also there's a very active advisor or distribution side community in India, right? So you can always contact your wealth manager or advisor as well to initiate your journey into active investments across asset classes. So when you look at these three elements, these are the three core ones. I would rather add one also provided by AMCs. Sometimes if you just want to buy a fund, you can go directly to the asset management company's website and platform and invest from there as well. Obviously, that will just give you access to that fund. The first three would give you access across all AMCs in India, right? Because those are the tech mechanisms feed into all asset management companies' schemes and funds available for subscription. So these are four options which are there. An investor can log into these and select an index fund of choice, a sector as well, and start his lump sum or SIP investment. It's very simple and it just takes a few minutes.